Hey, Lance Morgan here, and I am so excited to share with you our training on the retirement restoration. This is by far my favorite training because it has the biggest impact on the lives of our clients. All right, so triple compared to what? If I'm going to show you how to triple your retirement income, triple compared to what? What are the traditional retirement strategies that we are trying to beat? Okay, so let's talk about Retirement 101. Here's Retirement 101. You start here with no money. You save until you have enough money to retire. You then spend your money in retirement, and then when you run out of money, you die. How's that sound? Pretty simple, right? Save for retirement. Once you get enough money, okay, you spend the money in retirement, and then you die. Okay? What's the problem? What's the problem with this situation? Now, if you die over here, you're fine, but what if you die over here? Okay? Kind of messes up the plan a little bit, doesn't it? And that is when they came up with what we call the 4% rule. Here's how the 4% rule works. You're saving your money until you get enough to retire. Now, you might get a 10% return during your retirement years. Maybe not, maybe so. That's not the point. The point is that you eventually get enough money to retire. But now you might be a little bit more conservative. You might shift this aggressive kind of investing strategy to something more conservative. Maybe something that's going to get a consistent, steady, conservative 5% return. Then you're going to pay 1% to your financial advisor on average so they can go golfing every day and get that residual income. That gives you 4% to live on. That's where they came up with the 4% rule. You can Google it. There's a lot of people talking about it. But the idea is that you are living on the interest. You're spending your interest. Now, you may want to keep 20% of your money over here, and maybe you only put 80% of your money into these fixed accounts. You may do a little bit of something like that, but in general, you're going to be shifting in retirement. You're going to be shifting from more aggressive investing strategies to less aggressive strategies and try to live on the interest. Why? Because then when you die, you have the same that you started with because you're living on the interest. Okay? So your account isn't going down in value. Your account is staying level and you're living on that interest. So if you had $1 million at retirement, that $1 million would pay you $40,000 a year. That is the 4% rule in a nutshell. Okay? Now, there are 4 variables to consider with the 4% rule. First of all, stock market crashes, bond rates, inflation, and taxes. So, stock market crashes, stock market uncertainty. As you're growing your money for retirement, there's a lot of uncertainty. If you remember back in 2008, people had to delay their retirement for 10 years to get their money back before they could retire. Okay? Unless they timed it just right. But we've had a lot of ups and downs. So you might be getting close to retirement and all of a sudden lose half your money, and then you have to wait to get the money back. That can really mess up your retirement plans. That's a big uncertainty. How about bond rates? Have bond rates always paid 5%? No. Back in the 80s, they were even better than that. But we've had a lot of years recently where we were not earning 5% on bonds or CDs or anything that was safe. So to try to live on 5% minus the fees, 4%, it was more like the 2% rule. Okay? So for a long time, it was maybe like a 2 to 3% rule. That is also a huge variable to consider with the 4% rule. How about taxes? Did you know that way back in the day, in the 50s, the upper income tax bracket was taxed at 91%? Or how about during the 70s and early 80s, everyone in that high income tax bracket was taxed at 70%? Now, luckily, taxes have gone down, But do you think taxes are going to continue to go down? Or have you looked at our debt lately? Have you looked at the national debt? Do you think it's possible that taxes could go up in the future? If taxes go up in the future, you're going to potentially be paying more money in taxes in the future if you have money in an IRA or a 401k or any of these qualified plans where the government owns part of that money. So you are going to have to give some of that money to the government, which means that you may not be able to live on $40,000 a year out of your $1 million. You might only be able to live on half of that if they take half of your money in taxes. That's just a big variable, something to consider if you have money in an IRA or a 401k or something like that. So let's review. Here we have our money growing to retirement. How is it going to grow? Are we going to lose the money in the stock market and have to wait? Okay, so that rate of return is a big variable. Once we start to spend our money in retirement, are we really going to get 5%? That's a big variable, right? We've got stock market crashes here that we might have to recover from, okay? We have a big variable here with bond rates, okay? Inflation. If our income stays the same the rest of our lives, what about inflation? How are we going to keep up with inflation? We need our income to be able to go up, to be able to keep up with inflation. That's a big variable. That's a big problem. And what if our actual take-home amount goes down because taxes go up in the future and we're able to live on less? Another big variable. These are all things to consider with the 4% rule. Okay, so we're going to break this down into two phases: the growth phase and then the income distribution phase. So let's talk about the growth phase. First of all, let's go back here. So the growth phase is from here to here. So starting here till we get to retirement. This is our growth phase that we're going to focus on first. Then we're going to focus on this phase next. So we're going to break it down into those two phases, okay? All right, so you've probably heard of the rule of 72. If you haven't, you can Google it. But basically what that says is that you take 72, the rule of 72 says take 72, divide it by the interest rate that you're going to earn on your money, the rate of return that you're going to earn on your money, and that will tell you how many years it takes to double your money. Okay? So if you take your calculator and you take 72 divided by 10%, that means our money will double every 7.2 years. Okay? Now, let's take a look at why that might not be always some sound advice to follow. Okay, so here we have the stock market history from 2000 to 2022. Now, the average rate of return has been 5.9%. So we take 72 divided by 5.9%, and our money should double in 12 years. So we have $1 starting out in 2000. After we have the first little drop of 9/11 and the dot-com crash in here, our money dropped in the stock market, as you can see, 46% if you had your money tied to something like the S&P 500 index. That means your dollar actually turned into 60 cents. Then we finally had some good years leading up to the recession of 2007 and 8, but our 60 cents got back to our dollar. Now we're a long ways from doubling our dollar. We're still at even. We're still even at $1, right? Then we lost the money again in 2008 and we're back down to 60 cents. We then grew our money again. Let me scroll this down a little bit. Okay. After 2008, in 2011, our money was growing and we almost got to our doubling of our money right around here in 2019 is when we finally doubled our money. So what happened to the rule of 72? Why didn't we double our money in 12 years? The average return says 5.9, but the actual return on the money was 4.26 because of the impact of losses. So it took a lot more time to double our money because we kept losing the money and we had to make up for those losses, okay? Now I'm going to dive into that in a little bit more detail in a minute, but my point of all of this is that there's more to growing your money than simply the rate of return. You can't just pull up a little calculator and figure out when you're going to be able to retire. There is way more to the rule of 72, okay? It's a lot more complicated than the rule of 72. There are 4 considerations. Number 1, yes, the rate of return. That is important. We're going to talk about that. But there's also the average returns versus the actual return on your money and the impact of losses, which we looked at briefly. We're going to look at that again. There's also taxes to consider. What if you're paying taxes along the way? You're not going to double your money if some of your money is going to taxes. How about fees? How much are you paying in fees? You're not going to double your money if you're paying fees, right? These are all things to consider. So there's 3 ways to grow your money when it comes to rate of return. Let's talk about rate of return. There's fixed, there's variable, and there's indexed. Let's summarize. Here's fixed. Fixed means you're going from here to here in a fairly straight line. This is your CDs, your bonds, your money markets, your savings accounts. Basically, just slow and steady wins the race. The tortoise and the hare is kind of the analogy, right? There's whole life policies. There's various investments. But again, remember, it's not about the golf clubs. It's about the swing. But there's multiple products that are going to give you kind of a fixed rate of return. Then there's variable. Variable, most commonly, would be your stock market, okay? But it could be real estate, it could be gold and silver, coins, whatever the case may be. But there's some ups and downs. It varies. That's our variable. Then there's what we call the indexed, kind of a newer concept, which is where the money goes up, it flatlines, guaranteed to never lose, and then it can go up, so it looks a little bit something like that. So you get to participate in the upside of the market, but you have no downside. So I guess you could kind of say it's kind of in the middle of the two. Okay, those are your 3 options. Now, since most people are pretty familiar with the idea of growing your money in a fixed account and a variable account, I want to dive into this index strategy in a little bit more detail in case you're not familiar with this. This is how the indexing strategies work. What's going to happen is that the companies put most of your money into a safe conservative portfolio that on average is going to get around 5%. Okay? Then that is how they can guarantee you that you're not going to lose any money. But this is not how you could get a double-digit return, right? So how do they get you a double-digit return without any losses? Well, here's what they do. They take the money that you save and they calculate how much money would they need to save into this safe bond conservative portfolio that's earning around 5% to get you back to the $1,000 that you started with. Does that make sense? So they kind of work backwards to figure out how much do they need to save at 5% to get you back the $1,000 you started with. That allows them to guarantee you that you're not going to lose any money. Then what they can do is take $50 in this example, and they can put that $50 towards the stock market through what we call options trading. And they use options trading on an index like the S&P 500. That's why these are called indexed strategies, because they're buying an option on an index. Now, if you're not familiar with options trading is where instead of buying the index, so let's say that it cost you $100 to buy the index, but for $50, you could buy the option to buy the index in a year from now, okay, at today's price. In other words, you're buying a lottery ticket and you are gambling on whether or not you think that the index is going to go up over the next 12 months. If the index does go up over the next 12 months, you have the option to buy it at a lower price, which makes your lottery ticket worth a lot of money. So you don't even have to buy the index, you can just sell your lottery ticket. Now, depending on how much the index goes up will depend on how much your lottery ticket is worth. Okay, so let's take a look. So we take $1,000 plus our $100. If we turned our $50 into $100, that is $1,100, or the equivalent of a 10% return. That's a double-digit return without any risk of losing your original $1,000. Okay? Now, some of these companies are really good at this options trading, and you can watch YouTube videos on options trading if you want to learn more. But some of these companies are really good at these options trading, and they could turn $50 into $200. And that would give you the equivalent of a 20% return. Yes, it's very possible to get a 20% return. I've seen it many a times. Now, what if our lottery ticket doesn't win? What if the actual index goes down over the next 12 months? Who's going to want to buy your lottery ticket if it didn't win? It's not worth anything, right? So you're going to get a zero. You're going to lose that $50, but you're not going to lose the $1,000. Now, I want to give you one more scenario, okay? That is, of course, a 0% return. I want to give you one more scenario. What if we go back into an environment like the 80s where bond rates were really high, and even right now with interest rates really high? And what if we've got the market that is doing really well, like in the 80s? So what if we've got like the best of both worlds? What if we've got good rates on bonds and the stock market is doing well? Well, that's the best of both worlds for this particular strategy, because we may only need to use $900 in our account over here, in our bond account, to get us back to our $1,000. That gives us $100 to put into the options market. And on a good year, we might be able to turn that $100 into $400, which could be the equivalent of a 40% return. Yes, during the right conditions, these indexing strategies could get you these big returns without any risk of losing money in the stock market. Okay? That's how the indexing strategies work. Now, here's another way of looking at it. For those of you who have like an existing chunk of money, let's say you have some money in a retirement account and you want to move all of your money over into one of these indexing strategies. Well, if you do that, they're going to buy these bonds at whatever the current rate is. It's kind of like a one-time thing. It's not like a monthly savings. It's like a one-time thing. So it all depends on what the rate is when you move your money over. So if you moved over $100,000 into one of these indexing strategies, they're going to figure out how much do they need to invest at 5%, if that's the going rate at the time of the bonds. Okay, because what they're going to do is they're going to buy a 10-year bond. So they're going to figure out how much do they need to invest over 10 years to get you back your $100,000 that you started with. In this example, it's going to be $61,000. That gives them $38,000 to put towards the options. So that allows them to take that $38,000 and get double-digit returns on the $38,000. So the higher this number is, the better the overall performance is going to be. The lower that number is, the lower the overall performance of this type of scenario is going to be. Does that make sense? Okay, so you've got a couple of different scenarios. So this indexing concept can work if you're saving money every month or if you have a lump sum amount of money that you just want to move in one shot. Okay, this is basically what it would look like in an oversimplified way, but I want to talk about what we call the reset. Now, when you have money in the stock market and you lose money in the stock market, you have to wait for the stock market to come back to get you back to where you were before you lost the money. In the indexing strategies, you don't lose. Okay? You don't lose any of your money. So then, when the market turns around and comes back, you get the gain on all of your money. You didn't have to get out of the hole because you never fell in the hole. So every year it resets. Every year it resets. So in some ways, having the stock market crash can be a good thing for an indexing strategy because it usually bounces off the bottom and gives you a really good return the following year. And that good return could be on all of your money because you never lost any. So that's just kind of an example. Now, from 2000 to 2013, you could see how you could actually earn a lot more money in this indexing strategy than in something like the S&P 500. But of course, this is just looking at one little window of time. Obviously, there's a lot more to look at, but that's just to show you an example of how this works. Okay, so again, 4 considerations. We've talked about the rate of return. There's fixed, variable, and now index. So hopefully you're familiar and comfortable with all of those 3 different options. Now let's talk about average versus actual rate of returns and the impact of losses, and then we'll talk about taxes and fees. So let me ask you a question. If I could offer you a 25% average return, would I have your attention? That could solve a lot of your problems, right? Heck, you could probably triple your retirement income by getting a 25% return every year. That would solve a lot of problems, wouldn't it? Let me ask you another question. Would you rather have a 50% return on half your money or a 5% return on all of your money? Interesting, isn't it? Let's look at the average versus actual rate of returns. Okay, so here we have the actual versus average returns. So let's say that we're starting with $100,000. And again, remember, I offered you a 25% average return. So let's say that you give me $100,000. And in the first year, I lose 50% of your money. Sorry about that, okay? But I convince you to hang in there because next year is looking to be a really good year. And sure enough, okay, the next year we have 100% return on your money. 100% return on your money. Not a 50% return, 100% return on your money. But it's 100% on half the money because the previous year we lost half your money. So although you got a 100% return in the second year, it was a 100% return on half the money. However, if you ask your math teacher, down 50, up 100, that is an average of 25%. Now, yes, this is an extreme example to prove a point, but believe it or not, just a simple 5% every year, or actually a 0. Let's say that the first year, instead of losing 50%, okay? So in the first year, if we didn't lose that 50%, in the second year, we only got a 5%, not a 100% return, just a 5% return, we would still be money ahead. We would still be better off with just a 5% return because we didn't lose any money. That is the impact of losses and how they can affect your money. Yes, this is an extreme example, but in a minute we'll look at the actual stock market history. But this is just to prove a point of how actual versus average works. And here's the scary thing. A lot of financial institutions can sell products based on average returns. So you might get a product that has an average return of 10%. You do your little rule of 72 calculation, or you jump online to a compounding interest calculator. You think you're going to have lots of money for retirement. The next thing you know, you show up to retirement and you're a lot short. That's what you've got to consider, is how all of this really works. Okay, so now let's actually compare the actual rate of return of the fixed, the variable, and the indexing strategies. Now, the variable strategy is kind of hard, so I'm going to use the S&P 500 as a benchmark. Now, the reason is because even Warren Buffett says he can't beat the S&P 500. So I'm guessing that most of you are not consistently beating the S&P 500. Maybe you have a 401k, an IRA, money in the market. Maybe you have an amazing financial planner or a stockbroker who is crushing it and getting you way better returns than even Warren Buffett is getting. But for this particular video, let's just use the S&P 500 as a benchmark to compare the fixed, the variable, and the indexed. Okay, now to start with, I want to use the S&P 500 as our benchmark, but I'm not going to use the dividends because, like I said, most of you probably are not investing directly in the actual S&P index fund. So this is minus the dividends, but it's still going to be higher returns than most people are getting. I'm also going to take you down a little little history, a little trip down memory lane, and we're going to look at 1980 to 1999. Now, we need to talk a little bit about what was going on during this particular 20 years. This was when your baby boomers were hitting the peak earning years, and they started to take away their pensions. They started to replace their pensions with 401ks. It was also during the early 80s that Wall Street came out with mutual funds that allowed an average person to put $50 away into the stock market instead of only the wealthy being able to buy individual stocks in the stock market. So we had this perfect marriage. We had Wall Street's mutual funds that they put inside the 401ks. We had corporations that were getting rid of pensions and moving all of the focus to the 401ks, and we had the baby boomers reaching their peak earning years, and it was the perfect storm. The money just flooded the stock market. We had 25% returns. We had 14, 17, 26, 14, 12, 27, 26, and then we had Al Gore invent the internet, and what do you know? We had the dot-com boom. We had 34, 20, 31. By the way, I don't know if Al Gore really invented the internet. That was just a joke. But the point is in the late 90s, the market was going gangbusters, okay? During this particular 20 years, the average return was 14.67. The actual return was just under 14. Still really, really good. In fact, during that 20 years, if you had $1 to begin with, you would have ended up with almost $14 when it was all said and done. This is where buy term and invest the difference came out. This is where everyone wanted their money in the stock market. It was just the only place that people wanted to put their money. Okay? Now, let's fast forward a little bit and let's look at the last 23 years, starting with our first, let me go over here, our first little crash. We had the dot-com crash. Apparently, a website with a .com at the end was not worth millions of dollars after all. So we had the dot-com crash. We also had 9/11 in there. And if you had $1, it would have turned into, $1 would have turned into 60 cents. Okay? Fast forward, time goes on, over 23 years, the average is 5.9, but the actual has only been 4.26. So over 23 years, your dollar turned into $2.61. So during that particular time, let's say that we go with a floor of 5 and a cap of 5. That's just another way of me putting in 5% every year. We're going to call this a limited return because it's limited to $1. So we have a limited, 5%, sorry. It's limited to 5%. We're not going to get 13% returns. We're going to get 5. But we're not going to lose 38%. We're going to get 5. Okay? So, what strategy works best during this particular time frame? Believe it or not, your limited return, your fixed, this is the fixed strategy. Your fixed return would have done better. Now, in all fairness, let's take out the first couple of years there and let's start with 2003, where the market started off on a positive note of 26%. Let's just time it a little bit differently for that 20 years. Let's look at those 20 years. During those 20 years, the stock market, the variable returns would have done considerably better than the 5% fixed. Okay? Now, let's look at what we call the indexed strategy, which is a floor of 0. And the best way to kind of illustrate it in this software, and I can go into this in more detail later, but the idea is around 70% on the upside in general. So we're not going to get 13, we might get 9, okay? We're not going to get 29, we might get 20. Yes, you can get 20% returns and higher, okay? So in this example, we're going to have no losses, right? 0 is the worst we're ever going to get. Let me kind of clear this up a little bit. A lot going on there. Sorry about that. So we're not going to lose 38% in 2008. We are going to get a 0. Now in 2009, we're not going to earn 23%. We might only earn 16. But when it's all said and done during that particular 20 years, the indexing strategy would win. Now, let's go ahead and take out that 2008. Let's start with maybe 2009. Well, now during that 14 years, the actual variable strategy in the stock market would win if you are invested in something that is tracking the S&P 500. So there's a few variables there as well. All right, so my point in all of this is not to try to tell you which one of those three is better. I'm just trying to show you that it depends on the years and it depends on what you're actually looking at and what your objective is, okay? But there are 3 strategies to grow your money: fixed, variable, and indexed, okay? Okay, so back to our 4 considerations. We've talked about the rate of return. We just talked about the average versus actual returns. And now let's go ahead and dive into taxes and then we'll cover fees. So 3 tax categories. There's taxable, there's tax deferred, and there is tax exempt. Okay, so your money could either be taxed as it's growing, or it could grow tax deferred, meaning that you don't pay taxes while it's growing. And then there's tax exempt, which means you don't pay taxes when it's growing or when you take it out. All right? Let's talk a little bit about the tax history and dive into this in a little bit more detail. Okay, so let's take a look at the tax history. Over here we have the Great Depression, we have a lot of wars going on, we have lots of things happening in our history. But one thing we're going to focus on is that we have had very high taxes in the past, and we could potentially have high taxes in the future. If you are currently in a 20% effective tax rate bracket, all right, or an effective tax rate, not the tax bracket, but if your tax rate is at 20%, then if you have $100,000 in, let's say, an IRA or a 401k where you put the money in pre-taxed, then that means that you have really $80,000 and the IRS has $20,000. but it kind of depends on when you take the money out. So the real question is, what's going to happen in the future? Are taxes going to go down or are taxes going to go up? Because if taxes go up, for example, maybe they get up closer to our average line. If they get closer to our average line, then it's possible for the IRS to actually have more money than you do if your money is in what we call a qualified account where you deferred taxes until later. So maybe you want to pay your taxes now and get them out of the way if you think taxes are going to go down, or sorry, if you think taxes are going to go up in the future, you may want to pay your taxes now and get them out of the way. If you think taxes are going to go down in the future, then you may want to actually postpone your taxes until later. Now, you may have been told that you're going to be broke in retirement. You're not going to be making as much money, and so therefore you're not going to have to pay as much in taxes. Well, guess what? I'm going to show you 3 strategies to triple your retirement income. So if you're going to triple your retirement income, you could have a decent income in retirement, putting you in these upper income tax brackets, even in retirement. So you could still be paying a lot of money in taxes in the future, even though your kids might get out of the house, you might pay off your house, you might do all these things, you still could have a high income in retirement, therefore you might be paying high taxes. Okay, now I want to talk about what we call tax thresholds. This is very interesting. Let's take a look at this one. Now you might be saying, well, I am not in that top 1%. I'm not going to be paying a lot in taxes because I'm not in the wealthy category. Well, the taxes can be based on what we call tax thresholds. So way back to 1913, when the initial tax rate was at 1% to begin with, okay, you had to make over $500,000 to even be taxed at that 1%. Now, if we fast forward down here until we get into the 40s, in the 40s, they had raised the top tax rate all the way up to 81% if you made over $5 million. Now, I don't know who that was, okay, back in 1941 that was making over $5 million. Maybe it was one of the Rockefellers or something. I don't know. But watch what they did in 1942. In 1942, they raised taxes, but only 7%. They only went from 81 to 88%, but they lowered the threshold to be in that 88% to 200,000. We call that casting a wider net, okay? So they were casting a wider net to be able to get more people. They went from 5 million down to 200,000. Now, what else can we learn from history? Well, let's scroll down here and look at the Reagan years. During the Reagan years, okay, we had really low taxes, okay, but almost everybody was in the top income tax bracket because they lowered the threshold so low that even if you made $29,000 a year, you were in the top tax bracket. So there's a lot of things. They have a couple of levers that they can pull. They can raise the tax rates, and they can also lower the thresholds to be in those top tax rates. And now let's talk about what we call your effective tax rate. Okay, so the way your effective tax rate works is that if you make $250,000 a year as a married filing jointly with some standard deductions, your taxable income would be around $222,000. That puts you in the 24% tax bracket. However, not all of your money is taxed at 24%. The first $22,000 that you make is taxed at 10%. Then the $22,000 to the $89,000 that you make is taxed at 12%. And then from $190,000 from 190 to 364 is taxed at the 24% and so on. You get the idea here. So what we do is we kind of average it out, and that gives you your effective tax rate. So even if you are in a 24% tax bracket, you may only have to pay 16% in taxes. Okay, so the final thing I want to talk about with taxes is, should you pay your taxes now or later? One of the biggest questions a lot of people have. Okay, so let's say that our annual contributions to our retirement is $20,000 a year. And let's say that we are in that 20% tax bracket. And let's just say that taxes stay the same. Let's just say that when we take out the money in retirement, we are also in a 20% tax bracket. And let's just say that we have 20 years until we're going to retire and withdraw this money. And let's just say that we are earning 7%. That's our current scenario. The million-dollar question is, should we pay our taxes now or should we pay our taxes later? So if you have a qualified plan, a SEP IRA, simple IRA, a 403B, a 457, a 401k, an IRA, these are all what we call qualified plans where you get to put your money in pre-tax. The biggest misconception is that you get to save money on your taxes. Not true. What happens is that you get to put the money in pre-taxed, so that lowers your income and you pay less taxes that year, but all you're doing is putting $20,000 in, which is going to eventually grow to $877, but it's not all your money. Because you put your money in pre-taxed, you partnered with the IRS in your retirement. They own $177,000 of your retirement, which means your take home is $701,000. Now, here's where the big misconception comes in. If you decided to pay your taxes now, you're not going to invest $20,000. If you did invest $20,000 after taxes, then yes, you would have to pay more in taxes, but you're not. What you're going to do is you're only going to invest $16,000 because we need to pay $4,000 in taxes that year. So we're not paying more taxes, we're simply investing less, okay? So we're investing less. Now you might think that if you're investing less, then you're not going to earn as much compounding interest. That is true. You're only going to grow to $701,000, not $877,000, but it's all yours. You don't owe anything to the IRS. You already paid them the $4,000. You don't owe anything to the IRS. You get to keep all of it, which means it doesn't matter which one you choose. If taxes, whoa, dropped my pen. If taxes are going to stay the same. Now, what happens if taxes go up? If taxes go up by even 10%, now all of a sudden, your take home in the future is only going to be $614,000 because more money is going to go to your partner in your retirement, which is the IRS. If you had paid your $4,000 in the beginning, okay, then you're done. You still get to keep your $701,000. That is a big difference in retirement. Very, very, very important to understand. Now, if taxes go down in the future, then yes, you'd be better off postponing the taxes. But again, if you're going to learn 3 strategies to triple your retirement income, then you may want to consider what your taxes might be in the future. You may be in that upper income tax bracket and pay a lot more in the future. Okay, so back to our 4 considerations with growing your money during that growth phase of your retirement plan. We've talked about the rate of return. We've got the fixed, variable, and the index. We've got the average versus the actual. We've talked about the importance of, or the impact of losses. And now we've talked about taxes. We've got taxable, where you're actually paying your money or your taxes as you go, which, by the way, we didn't talk about that a lot, but that one is the worst of all because you're actually paying taxes, and that money that you pay to the government is not compounding interest. So you want your money to grow tax deferred, and then ideally you would want your money to be tax exempt or tax free when you pull the money out. So now let's talk about fees. Okay, so with fees, there is no fees. You can take your money down to the bank. No fees for that. You can stick your money under your mattress. No fees for that either, right? Taxes and fees. Now that adds a lot of expense, right? Yes, taxes could be considered an expense or a fee, okay? Percentage of assets under management. That was what I did the first several years of my career. I put everybody's money under management and I got paid residual income on all of that money under management. But that costs you a fee. You pay a fee for those assets under management. And then there's what we call front-loaded fees, where you pay a little higher fees up front so that you can pay less fees in the end. All right, so let's break it down, okay? Taxes and fees is the red line here. By far the most expensive. By far the most expensive, because as your money grows, if you ever look at your tax return and it says dividend income or interest income, if you're paying dividend income or interest income, that's a tax that's going over here and not compounding interest. That's adding to your expenses. Then we've got fees on the government's money. If you are putting your money into a qualified plan, like we just discussed a minute ago, then you are actually paying fees on your money and the government's money. That's why everyone in the financial industry wants you to put your money in qualified plans, because they earn a fee, they earn a commission on your money and the IRS's money. You know how we just looked at that a minute ago? If you have more money in your account, then you're going to pay more in fees to the financial advisor, okay, or the money manager. Okay, so then, let me go back. And then we have front-loaded fees. Front-loaded fees, tax exempt. Tax exempt. That would be like a Roth IRA or something where you've paid your taxes and it doesn't get taxed in the future. You're actually paying less in fees over time. And then we have front-loaded fees. Front-loaded fees are where you're paying more fees initially, but less fees over time. Now, here's the question. How much does this really matter? Do fees really have much of an impact on the growth of your money? Let's look at 6% in 4 different scenarios. So we're growing our money. We're growing our money from age 50 to 95. We're growing our money at 6% in all of these accounts. Okay? Taxes and fees do make a huge difference because, remember, taxes and fees put your account clear down here. If you're paying all those taxes and fees, you're clear down here at the bottom. If you paid your if you paid your fees up front in what we would call a front-loaded fee scenario, you're going to have the most money. Now, you would think that this blue one is really close to the green one, but remember, that is not all your money. Some of that money in that blue line belongs to the IRS. So the blue line is really down here with the purple line depending on your taxes. So this is not all your money in the blue line. And then of course we have the purple, which would be the tax exempt money. So you can see that on the growth of your money, the account value, the growth of your money, how much you pay in fees makes a huge difference. Okay, let's summarize the growth phase of our retirement plan here. We have the rate of return, fixed, variable, and indexed. We have the average returns versus the actual returns so that we can accurately calculate the future value of our money with the impact of losses in there. And we've got the 3 tax categories to consider. We've got taxable, tax deferred, and tax exempt. Okay? And then we've got the fees. There's no fees, there's taxes and fees, there's a percentage of your assets under management, and then there is also the front-loaded fees. So that's kind of the summary of the growth phase of your money. In other words, there is more to growing your money than rate of return. Rate of return is part of it, but just part of it. It's way more complicated than the rule of 72 and just pulling out your calculator to try to figure out how you're going to retire. All right? Now, which club is best? Which out of all of the strategies, the tax strategies, the growth strategies, which strategy is best? Well, again, it's not about the clubs. It's about the swing. The swing is by far more important. You need several clubs to play the game of golf. It depends on where you're at on the field. If you're 100 yards from the hole or 10 feet from the hole, that's going to change which club you use. It's not about the clubs. It's about the swing. Okay? That is what's the most important. Here's the problem. The problem is that we've all gotten into the habit of saving and spending. You saved maybe for your first car. Maybe you saved for a down payment on your house. Maybe you saved for your kids' college and paid cash for college. And maybe you're saving for retirement and you're planning on spending the money on retirement. Yes, we talked about the 4% rule and the way to kind of fix that, but you're still interrupting the compounding interest. We know compounding interest works best over time. So we need to let the money grow over time, uninterrupted. So we have our money in the 4% rule. We grow and then we spend it. But by spending it, 4% in retirement, what we've done is we've killed the growth. That's the biggest problem with the 4% rule is we've killed that compounding interest. Okay? So this is a new way, okay? A new way to save and pay for retirement. Now think about this for a minute. What if you could use your retirement savings as collateral, kind of like using a house as collateral or a car as collateral? What if you could use your retirement savings as collateral and borrow money for retirement? Now, I know most people's brains just exploded when I said that, right? Borrow money for retirement for less interest than you could earn on your retirement savings. It looks like this little chart right here. What if you could allow your money to continue to compound interest, use it as collateral, and borrow the money for retirement at a lower interest rate? And what if you weren't required to make any loan payments? So your loans would just compound interest, but as long as they're compounding interest at a lower rate than your retirement savings, you benefit from a 1% at least, maybe 2, maybe 3% positive spread, and all of your money keeps compounding all the way through retirement. No matter how old you are, whether you're already in retirement or whether you're just starting and you just graduated college and you're looking at a retirement plan, what if you could allow that money to compound interest the rest of your life? And this is really going to blow your mind, so you might want to sit down for this one. What if you could borrow money from the bank to save for retirement at a lower interest rate than you could earn on your retirement savings? How crazy is that? Okay? What if the bank would loan you money to save for retirement? How cool is that? Now, we're going to talk about two different strategies here. We're going to talk about with the bank and without the bank. Let's talk about without the bank first. Okay? We'll work up to that one. Okay? I want to set the stage a little bit with this article that came out. about the secret trove of these wealthy people that weren't paying their fair share in taxes, and everyone reposted it. It was all over the internet. And they talked about how Warren Buffett, Jeff Bezos, and Michael Bloomberg and Elon Musk were not paying their fair share in taxes. Now, of course, many people were very upset to find out that the ultra wealthy were not paying their fair share in taxes. But what I thought was interesting about this article was how. How are they doing it? And what can we learn from the wealthy? Well, here we have some Amazon stock and some Tesla stock. And in the article, it says that their wealth derives from the skyrocketing value of their assets. I call that uninterrupted compounding interest. Those gains, okay, are not defined by U.S. laws as taxable income unless and until the billionaires sell. If they never sell those assets, they could leave those assets behind to their kids in what we call a step up in basis, just like the real estate. Same as the real estate. If you have stocks and you let your stocks grow the rest of your life and you leave your stocks to your kids, then they get what they call a step up in basis. Now, how in the world, okay, do these mega billionaires pay their mega bills while paying themselves dollar salaries so they don't have to pay a lot of income taxes and hanging on to their stocks? How are you going to live in retirement if you hang on to your stocks? Well, according to the public documents and experts, the answer for some is borrowing money. Lots of it. Crazy, isn't it? But yes, the wealthy understand the benefits of borrowing money. Now, here was a funny video that I saw on Instagram. Actually, somebody sent it to me. And I don't really even know who this person is. I'm not necessarily, endorsing what he is saying, but it's kind of funny in a very short little clip about what he says about borrowing money and how the wealthy think about money a lot differently.
Why do you hate Dave Ramsey?
I don't hate Dave Ramsey. I just hate everything he teaches. He's teaching people to be poor because he wants them to take their 40 years of time that they have to make money, and he wants to donate it to getting out of debt and paying crap off. You can't eat no debt. You can't travel on no debt. There's a flaw in the practice. Everything is about eliminating debt. If you have credit cards that are like at 18, 19, 20%, you should probably get those eliminated. But when people have most moderate debts at 4, 5, 6%, and you fire people up in a frenzy to, oh my gosh, hurry, you shouldn't be able to sleep at night, get your debts paid off as if the world's worst thing. It's called positive arbitrage. I borrow money at 5% all day long and get it making 20%, 30%, 1,000%. And when I borrow at 5 and I'm earning 20, the difference is 15. I'm making 15 on debt. That is a productive debt. It is a good debt. That debt makes me money. And Dave just wants to act like all debt's bad. I'm like, no. Consumer debt is bad, but debt is what this country is built on. Debt is what the wealthy are built on. Debt is about controlling money to make money. And that has fallen on deaf ears in his community.
So should I pay off my house?
Never.
Okay, now, again, I don't have an issue with Dave Ramsey. I'm not endorsing or saying anything about this other than it's a very interesting way of thinking that goes totally against everything that we've ever been taught. Now, I want to ask you this question. Do you think your income is common or uncommon? Let's take a look at what I call the income game. Now, I want you to think about this for a minute, and I want you to think, you could pause the video and answer these questions if you would like to play this game. But how much do you think you would have to make in this country to be in the top half wealthiest people in the country? So the top half wealthiest people in the country, how much do you think you would have to make? How about the top 25%? How much do you think you would have to make combined? This is adjusted gross income combined in your household. Husband, wife, the whole household. How much would you have to make to be in the top 25% of this country? Or the top 10? Or the top 5? Or the top 1? Go ahead and pause the video. Take a guess. And while you're at it, you could also guess how much they all pay in taxes. All right, now let's take a look. Would you be surprised to find out that it only takes $42,000 a year combined household income to put you in the top half wealthiest people in the country. Okay? How about 85,000 to be in the top 25%, or 152,000 to be in the top 10, and 220,000 puts you in the top 5, and drum roll please, $548,000 puts you in the top 1% wealthiest people in the country. So where are you? Are you at least in the top 25% of the country? Here's why I bring this up, is because if you are in the bottom half of the country, you should probably listen to Dave Ramsey and do everything he says. You should get out of debt. You should stay out of debt. You should probably work the rest of your life, because you're probably not going to be able to save enough money to retire. You better love what you're doing. But if you are in the top at least 25% of the country, or if you want to be in the top 25% of the country, you need to think like not only the top 1%, I'm going to argue like the top 0.1%. It's the top 0.1% that really understands some of these financial strategies. I've talked to tons of clients in the top 1% that don't understand some of these financial strategies. And this does play in, of course, to our tax conversation that we've talked about as well, because the top 1% is definitely carrying the load, all right? And between the top 25%, 88% of all the taxes are paid by the top 25%. That could also be something to think about when it comes to whether or not you think taxes are going to go up or down in the future. If you think you're going to be broke in the future and you don't need to worry about taxes going up, you might want to think again, because you're probably in a higher percentage than you think. And you are probably what they consider to be wealthy, and you may be paying a lot of the taxes. Now, in order for this strategy to work, we need 3 components. We need uninterrupted compounding interest on our money. That's the most important. We also need loans at a lower rate. That's also important. And then we need optional loan payments. We don't want to be making a loan payment while we're in retirement. We're not going to try to take out a home equity line of credit to retire on and then have to make a loan payment on that in retirement. Of course not. We need optional loan payments because we're going to live on loans in retirement at a lower interest rate, and we're going to allow this uninterrupted compounding to do its magic, right? So how do we accomplish this? Are the banks ever going to offer you a loan at a lower interest rate than what they'll give you on a savings account? Of course not. The banks are the ones making money doing what I'm trying to teach you how to do. The banks understand what we call positive arbitrage, or positive gains, or a positive or leverage, whatever you want to call it. The banks are giving you a loan at 5 or 6% or 7 or 8% and giving you less than 1% on your savings. That's obviously not going to work. How about taking out a 401k loan? Does your employer hand you a check when you take out a 401k loan so that all of your money can keep growing for retirement? Of course not. They are simply giving you early access to your money without a penalty. That's all a 401k loan is. And of course, you have to pay it back. So there's no optional loan payments. How about margin loans? Now, we're getting there. We're getting closer. Remember the wealthy? Remember Elon Musk? Remember Jeff Bezos? They could allow their stocks to grow the rest of their lives, and they could take out what we call margin loans. A little risky, because if you don't have as much money as they do, first of all, they're only going to let you borrow up to about half. And if the stock market crashes, they're going to make you sell your stocks to pay off the loan. A little more risky, but it could work. And the other problem is hard to live on in retirement, because they're going to make you make a loan payment on those margin loans. So it could work for part of the strategy, but not all of it. How about real estate? Could your house appreciate at 6%? And could you get a mortgage? Harder and harder these days. But could we get a mortgage at some point in time in our lives at 5%? Yes, we could. Okay, so that could work. Have you ever met a mortgage company that will give you a home equity line of credit or a second mortgage or a first mortgage without making you make a loan payment? Unfortunately not, right? The banks tend to want these loan payments. How about a reverse mortgage though? Believe it or not, a reverse mortgage could work. We could borrow money from the bank using our house as collateral. We could have all that money to live on in retirement without making any loan payments. Now, again, I could spend a whole nother training talking about that. I'm not going to go into that in this particular training because some of you are a lot younger and this is not going to apply to you. This is only going to apply to those who are older, but it is an option for those of you who are older. How about whole life? Whole life is going to allow you to grow your money uninterrupted, and they do allow you to borrow money without a loan payment. That's interesting. But your average return on a whole life policy is going to be in that 4 to 5% range. This is in that fixed category. The growth on this is fixed. It's in that fixed to 4 to 5% range. And the loans are just like a bank. Okay, whole life companies work like a bank. They're going to try to charge you 6 to 8% on your loans. So your money is going to grow like this. Your loans are going to grow like this. It's not going to work. Even though they give you an optional loan payment, you're going to need to make a loan payment or this whole thing is going to go south in a hurry. So it has an interesting feature, but not quite what we're looking for. How about the new kid on the block? The Index Universal Life Insurance. This is using that index growth that we keep talking about, where your money is actually growing like this. Okay? You're guaranteed to never lose. You can still get the upsides. That's going to give you that 6 to 8% average return. And if you choose the right company, you can get a fixed percent loan at 5%. Right now, with interest rates high, you could take out a loan, give it to somebody in a hard money loan at 10% and make money on the loans. Yeah, even with high interest rates, you're guaranteed to be able to borrow the money at 5%. I teach people how to use this to pay for college because you could borrow the money to pay for college and have all of your money keep compounding interest. And yes, we still get the optional loan payment. There's only one problem, and that is the high fees of the life insurance. That's why everyone says, don't ever use life insurance as an investment. It's too expensive. I know this because that's how I was taught. I was taught when I started in the financial industry to tell everyone, never use life insurance as an investment because it's way too expensive. Okay? Now, here's the secret. High fees equals high commissions. Low fees equals low commissions. There is a way to keep the fees low. In fact, this is what the wealthy do. This is how the billionaires, the banks, and the large corporations use these index universal life insurance differently. Here's an example of bankdirector.com. You can go to the website and they'll teach you how banks use life insurance. It's different than traditional life insurance contracts, okay? High cash value. That's like having an insurance company savings account. This is not term insurance. This is like having an insurance company savings account. High cash value, low insurance. That's the key. The cost is low compared to other insurance products. The problem is that insurance agents get paid a commission on the insurance. That's why nobody does this. But the banks, the large corporations, and the billionaires are doing it because the fees are low. Even Tony Robbins talks about it in his book on Money Master the Game. He went out and interviewed like 50 of the smartest people when it comes to money. And in chapter 5, he actually talks about the secrets of the ultra wealthy that you can use too. And they like it because of the tax advantages. It's a legal way to invest all without paying taxes on the gains. Pretty cool, isn't it? They call this a rich person's Roth IRA, but it's not even the billionaires that are using it the most. It's the banks and the large corporations. In fact, clear back in 2014, Wells Fargo had $18 billion in what they call their tier 1 capital in life insurance, cash value. Have you ever wondered where the banks are investing their money? Yes, they are using some of these strategies because of the tax benefits. You can borrow against them. They have all sorts of benefits. They're guaranteed to never lose, the whole 9 yards, okay? So the big secret is low insurance, high cash value. The insurance savings account. That is the key. Let's take a look in more detail. Okay, so let's take a closer look at what the billionaires, the banks, and the large corporations are doing and what we call a maximum efficient contract. So when you're talking about $500,000 of life insurance, as an example, there is the minimum that you can pay for that, and then there's the maximum. Now, the minimum makes sense. When it comes to insurance, you don't want to pay any more than you have to, right? But why is there a maximum? Well, the insurance company sets the minimum and the maximum is set by the government. Now, why do you think the government sets a maximum on how much you can pay for life insurance? Well, back in the 80s, they came out with what we call qualified plans. Now, a qualified plan we've already talked about, but it's IRAs, 401ks, SEPs, Simples, 457s, 403bs, anything where the government is a partner in your money and they get a piece of it when you take the money out during retirement, right? So during the 80s, they also came up with this maximum amount that you can pay for life insurance that they call a MEC, or a modified endowment contract. Now, a modified endowment contract says that if you go above this line, you have to pay taxes on the money that you take out of the life insurance. And remember, the idea is that all this money is supposed to be tax-free. That's why the wealthy like it. But the problem is that the wealthy were taking advantage of this back in the 80s. They would buy these little policies and they would drop millions of dollars into these policies and all that money would be tax-free. Well, the government figured out that this was a big tax loophole and they put this maximum line on life insurance. So you could pay $500 a year for this $500,000 of life insurance, or you could pay $10,000. Now, why in the world would you pay $10,000 for something that you could get for $500? Well, that's because if you only paid $500, all you're going to get is what we call term insurance. So term life insurance is just a death benefit. It's just insurance. That's it. There's no investment or savings vehicle benefit. It is just life insurance, right? Now, if you want tax-deferred growth on your money, and if you want to be able to access all of your money tax-free, and if you want to have a competitive return like that indexed return that we've talked about, where you could get 6 to 8% returns and no stock market losses and high contributions, maybe you want to pump in over $100,000 or $1 million a year into one of these plans, then you can. Additional benefits, they actually come with things like long-term care riders and disability riders. There's other benefits that can come along. Collateral opportunities. That's what we're talking about in this section. Being able to use your money as collateral and borrow at a lower rate. Or do you want it to be safe from lawsuits, creditors, bankruptcies? How about no losses? When the stock market crashes, you're guaranteed to never lose. How about guaranteed loan options? Would you like to be able to borrow against your policy without any sort of application or credit check? Or how about no loan payments, unstructured loan payments? Remember, these insurance companies will give you a loan against your policy and not require any payments. Liquidity, use, and control. That just means you have access to your money. And deductible contributions. In this case, you're not going to get a deductible contribution because you get tax-deferred growth and tax-free distributions. So that's the only one that you don't get. But all these other benefits are what we call living benefits. So if you pay $500 for that $500,000 of life insurance, then you're going to get what we call death benefits. That's what you call term insurance. Term life insurance is just a death benefit. But if you want what we call living benefits, all of these benefits that I just explained, then you want as much of those benefits as you can get. And that's what we call a maximum efficient contract. Think of it like an apartment complex. If you build an apartment complex, you don't want 30% occupancy, you want 100% occupancy. Now that doesn't mean that you have to have 100% occupancy, and this is where everyone goes wrong. See, people buy life insurance for all these benefits, but then they only pay on the low end, which means all of their money is going towards the expenses that the insurance company needs. The insurance company needs a certain amount of money to cover the insurance, right? So if you pay on the low end, all you get is the insurance with a little bit of these benefits, but most of your money is going towards the fees. Very little of your money is going towards all of these living benefits. So that's like having an apartment building that's only at 30% occupancy. Maybe 30% occupancy covers your mortgage payment and maybe your basic utilities, but it's not going to give you a lot of profit. Okay? You want what we call a maximum efficient contract. So when you set up a life insurance contract to be maximum efficient, you want to pay the maximum amount the IRS will allow you to pay. Now, you could put in $1,000 a year, $10,000 a year, $100,000 a year. You could put in $1 million a year into these life insurance plans, but this number would have to change and this number would change. So all three of these numbers go together. Now, if you want to drop $1 million into this product, then you can, but this number has to change. And generally speaking, so that you don't create a mech, you want to spread it out over at least 5 years. So to avoid a mech, just think of it as putting the money in over 5 years. Now, if you don't care about the tax-free distribution, then you could, put the money in one shot. A mech just loses that tax-free distribution. So a mech isn't necessarily bad. You just lose the tax-free access to the money. But if your plan is just to leave this to your kids, and you don't plan on accessing the money, then a mech will still pass tax-free, income tax-free as a death benefit. So I'm not saying a mech is bad. In fact, in the college funding world, sometimes we use mechs as a way of repositioning assets to lower what we call the EFC number or the SAI number, which helps families get more financial aid. But that's covered a little bit more in some of our other videos. The point is that when you're buying life insurance, what the billionaires, the corporations, and the banks are doing is what we call a maximum efficient contract. They're putting in the maximum amount that the IRS will allow them. And that is what you should also do. That is what keeps the fees low, okay? Insurance low, maximum cash value. And then you get all of these benefits that we're looking for. And it works great with low fees. Low fees. The fees are low. Let me explain more. Okay, so if you create one of these maximum efficient contracts with low fees and maximum cash value, so low insurance, maximum cash value, the fees are a little heavy up front, but then very low over time. In fact, this is showing you how the fees would compare against these other products at 1%. So if you're paying 1% in fees for a taxable brokerage account or an IRA or a 401k or a Roth IRA, the fees are much lower. Let's actually put some numbers to it. If you're putting away $10,000 a year for 10 years, just $100,000 at 50 years old to 95 years old, the fees, if done correctly, the fees would be around $65,000. Now, it depends on your age and a number of other factors. But at 1% on $10,000 for 10 years on a taxable brokerage account over all those years, because of the taxes and fees, would be more like $224,000 or $182,000 on an IRA or a qualified plan. and 131 on like a Roth IRA or something like that. Now, the reason why everyone hates life insurance and everyone on the internet says don't use life insurance is because they're doing it wrong. They're buying maximum insurance. They've got a 30% occupancy in their apartment building, right? They talk about all the benefits, but then they pay the lowest amount, so all their money is going towards the fees. $467,000 for the same scenario. So one is done correctly, one is done wrong. Same product, same rate of return, same benefits, but all your money is going towards the fees. Obviously, that is not going to be very attractive, is it? All right, let's put some actual numbers to it because this is so important. Because if you talk to your financial advisor or if you start Googling this on the internet, everyone's going to say, oh, life insurance is so expensive. It is if done incorrectly. So let's take a 50-year-old and let's say that everything is earning 6%. So 6% interest across the board in both scenarios. I'm going to show you two scenarios. Okay. Let's look at $10,000 for 10 years. That's $100,000 and nothing more. So no more contributions. We're done after 10 years. Okay. In the red, we have maximum insurance, maximum expenses, maximum commissions to the insurance agent, and minimum cash value. This is not what I'm talking about. Look at the life insurance. The life insurance is $290,000, and look at the expenses. Okay? The expenses are increasing as you get older. That's what happens in these policies. So if I scroll down, you can see that the expenses are getting huge because you are now in your 80s and your 90s and you're still paying for $290,000 of life insurance. So as you get older, the cost of the insurance gets higher. That's why everyone says, oh, don't do it, don't do it. Look at the fees. Look at the interest. Would you like to pay $467,000 in fees and only earn $367,000 of interest? Of course you wouldn't. I could talk you out of doing this in less than 30 seconds, okay? But what if we go back up here and what if we go with a maximum efficient contract? What if we go with an apartment building that's at maximum occupancy? That's what we call minimum insurance, minimum expenses, minimum commissions, because you're getting paid commissions on $125,000 of life insurance instead of $290,000. But that is the lowest amount that you can do to make the IRS happy. Maximum cash value. Look at the cash value in this plan, okay? Look at the expenses. Now, the expenses do start out a little high, but then the expenses go down as we reduce the insurance. Now, let me zoom in here and let me scroll down a little bit. This over here on the right, the far right, is our insurance column. Most people don't know that you can even do this. This is the secret of the billionaires, the banks, and the large corporations. You can reduce the insurance over time. So now, even though you're getting older, your expenses are going up a little bit, but not very much, okay? Because your insurance is low. And look at your cash value. Your cash value or your insurance company savings account is getting bigger and bigger and bigger. Your compounding interest is getting bigger and bigger and bigger. So if I scroll down, we're talking about $65,000 in expenses versus $467,000 of expenses. We're talking about over $1 million of interest instead of $367,000 of interest. And our insurance is next to nothing. It's like $11,000. instead of $290,000 in the wrong example. So if you're buying this for maximum insurance, then go with the example in the red. If you're buying it for maximum cash value, minimum insurance, okay, then go for the one in the blue. Same product, same 6% rate of return, same 50-year-old client, same $100,000 contributed. One is set up for maximum cash value, one is set up for maximum insurance. That is the secret. Okay, so how can life insurance earn 6 to 8% without stock market losses? The index strategy, we've talked about this index strategy the whole time. The index strategy is how they can do it. This is a client that literally started in 2007, April of 2007, right before the crash of 2007 and 8. So for 2 years, the lottery ticket that they bought for those options on the index was worthless. They got zeros for 2 years in a row. Now we were quoting our illustrated performance. We were quoting almost 6%. 5.95% is what we were quoting back in the day, 15 years ago, okay? They did not get 5.95%. They got zeros for 2 years in a row. But then they got an 18.8% return in the third year. Yes, a double-digit return in a life insurance product. They got 18.8. This is not hypothetical. This is a real client. These are actual returns. Then a 9, a 1, a 7, a 12. The thing that I love about this example is it's one of our worst case studies because they had 5 out of the 15 years where they didn't earn any money. They got a 0. Remember how the indexing strategy works. When you pay money for those options and the options don't pan out, you lose that money, but you don't lose any money in the stock market. The worst you could ever get is a 0. And you can see that in the good years, they can get double-digit returns. Now, this one isn't super sexy. It's only a little over 6% for those 15 years. But maybe next year, we have a good year, and maybe that puts them over 7 on average. And here's the best part. You can borrow the money to live on in retirement, or you can borrow the money to pay for college. You can borrow the money to pay for taxes. You can borrow the money to invest in the stock market or to buy a piece of real estate at 5%, and all of your money continues to compound interest. Now, we were estimating that this client would have about $353,000 by now, and they are at $385,000. They're ahead of schedule, okay? So I'm going to show you some case studies in a minute where I'm going to show you a 6% return and a 5% loan. I want to show you what it would look like with just a 1% spread. But it is possible to earn over 6%. In fact, this is one of the 50-something companies that we work with that started with this product. This product came out in 2006, and this is now 2023. And through the end of 2022, this particular product has averaged across the board on all of their policies. The average is a little over 6%, but it kind of depends on when you started. If you started back here prior to the recession, then your average return is going to be a little over 6 by now. If you started after the recession, your average return from now, overall, this is not a year by year return. This is the overall average return for all these clients. Everybody who started right after the recession has averaged a little over 8. Everybody who's started right in that 2010, 11, 12, their average so far is a little over 7. You can see, however, that the people who just got started, because 2021 was pretty good, but 2022, they got a 0. All right, 2022, they got a 0. So their average isn't over 6 yet, but give it time. Give it the rest of your life. How much do you think you can earn over the rest of your life. I don't care if you're in your 70s. My biggest client started at age 72, put in almost over $700,000 a year, and is retiring on $250,000 income tax free and could qualify for food stamps. Nobody knows about it. It's a loan. He's living on loans, okay? Because you can borrow the money at 5 in this example with this product. You can borrow the money at 5. So all of this is what they call a positive arbitrage. It's called a positive spread on your money. This is exactly what the banks are doing. Okay? If you could borrow money for less than what you could earn, why would you spend your money? If your retirement savings was averaging 6% and you could borrow the money at 5% in retirement, why wouldn't you? If you didn't have to make any payments on those loans, and then when you die, the insurance company will just take what you owe them. All right? In the contract, it says it's locked in when you purchase your policy and won't change. 5% every year, guaranteed. In a high interest rate environment, you have the ability to borrow money at 5% guaranteed, and all of your money continues to earn whatever the index earns. It might be 18%, it might be 0, but the average, if the average is over 6, then you get a positive spread on your money. All right, so let's take a look at some case studies. Let's tie all this together with some actual real numbers here. I'm going to show you 6% average returns and loans at 5%. I want to show you just what 1% will do for your retirement income. Okay, in this first example, I want to look at a 40-year-old. This is a 40-year-old that is saving $18,000 a year for retirement. Now remember, this is after-tax money. So he's already paid his taxes and he never has to pay them again. Okay? If he does it correctly through loans, they are income tax free in retirement. So he's putting away $18,000 a year after he's paid his taxes, and this is not a requirement. If you have a bad year, if you lose your job, if you have a financial setback, you do not have to pay $18,000 a year. That is the maximum efficient contract. In fact, he can't pay any more than $18,000 a year because he's buying $300,480 of life insurance. I know it's a weird number, but that is to avoid the MEC. The $300,480 is what he has to buy to make the IRS happy and get all the tax benefits. That's the lowest he can get away with. Your numbers will be different, but that's what his numbers are. Now, he's putting away $18,000 a year all the way until retirement. Now, the fees are going to start out high and then they're going to go low. Your interest, I'm showing 6%. You could earn 7 or 8 over time, but this is looking at 6%, okay? As you can see, it takes a few years, well, right around in the 3rd year, 4th year, is when you start to earn more interest than what you're paying in expenses, okay? Your account value starts out in the hole because you put in $18,000, the expenses are higher than the interest, so you start out in the hole. And the insurance company does not give you full access to all of your money. So think of the account value like your house, okay? And think of the available cash value like the equity in your house. It's the amount of money that they're going to give you access to. So you can, and let me make this very clear, you can take out a loan in the first year right away. The day after you make your first payment, if there's money available, you can take a loan. You don't have to wait until you're in retirement. You could use this money as an emergency fund. You could use this money to borrow against it to pay for college. You could use this money as a down payment on a piece of real estate. You could use this money to buy stocks. You could do whatever you want. This is money that you can borrow. This is available to you. But you'll notice that it's not until after the 12th year for this product. Some products it's after 10. This product it's after 12. But that's when you have full access to all of your money. But even though you have access to this money, you are compounding interest on the account value. So the compounding interest is on the big number. And if you were to die, you are going to get the account value plus the life insurance for your death benefit. So your death benefit is the account value and the life insurance, unless you have a loan balance. If you have a loan balance, then the loan balance would get paid off upon death, and that would of course come off of the death benefit. But as long as we don't have a loan balance, your account value and your life insurance equals your death benefit. All income tax free, okay? So your expenses are going to eventually get lower. Your interest, of course, is going up. Your account value, of course, is going up. And all of this is growing income tax free, right? Your available cash value is eventually the same. You have your life insurance. Now, here's the secret. Let's scroll down. Let's scroll down here. Okay. As we scroll down, you can see that eventually we are going to start borrowing money. Now, I know the headings are a little off on this, but this column is our tax-free policy loans. We're borrowing the money from the insurance company, income tax-free. Okay? There's no capital gains tax, no income tax, the whole 9 yards. Now, here's what I want you to pay attention to. Our account value has grown to $1 million. And we are able to borrow 8% in this estimate. 8%. That is double the retirement income. Now, I know I promised triple the retirement income. That's next. I'm going to show you that one next. But just for starters, we're already at double the retirement income. Why? Because of uninterrupted compounding interest. Let me say it again. Uninterrupted compounding interest. I am not stopping the interest. Now, I've stopped the payments. I'm no longer making any more contributions because I'm retired now. When we retire, we can reduce the insurance. When we're done making payments, we can reduce the insurance. Now, if you only make payments for 5 years or 10 years, you can reduce the insurance after you're done after 5 or 10 years. But in this example, we're making payments all the way until retirement. And now in retirement, our money is still growing. Think of it like taking out a home equity line of credit against your house without a loan payment. Wouldn't that be cool if you could just take out a bunch of home equity line of credits? You could just borrow $80,000 a year off of your house and not have to make any payments on that? Well, that's actually called a reverse mortgage. Again, for people who are older, that's something to consider. Not really what we're going to talk about in this particular video. But my point is that in this life insurance, we are living on $80,000 a year in retirement, income tax free. Income tax free, $80,000 a year off of $1 million. Okay? Now, our available money is going down a little bit, but not much. So it's just like the 4% rule. We're still going to leave money to our kids. In fact, if I scroll down a little bit, let's look at this down here. Let me scroll out just a little bit. Okay. Our total expenses our total expenses end up being about $300,000, and we've earned an estimated $6 million. $6 million of interest because we never interrupted the compounding interest. Can you imagine if your retirement could compound interest the whole time, the whole 20 or 30 years you're in retirement? How powerful is that? Now, would you pay $300,000 of expenses to earn $6 million of interest? I think so. Your account is over $6 million. We only invested $450,000, or I should say we only saved $450,000. This isn't even technically called an investment because it's guaranteed to never lose. So there's no risk of losing your money. The only thing that is going to come out are the expenses. Now, how are the expenses getting paid if you're not making any more contributions? The expenses come out of your account. As long as there's money in your account, the expenses can be paid. So that's why you could skip payments even in the second, third, fourth, fifth year. You could skip payments and the expenses just come out of your account. Think about it like having a car payment that comes out of your bank account. As long as there's money in your bank account, the car payment can be paid, right? It works the same way. The expenses are technically coming out of the available cash value. You are not required to make these contributions as long as there's money in your account to cover the expenses. Remember, the expenses are the minimum. Remember the minimum line. The expenses are the minimum that the insurance company requires. The $18,000 that I was showing you is the maximum the government will allow in this example. Okay? So, when it's all said and done, and you're laid to rest at 95, your account is at $6 million, but you've borrowed $2.4 million in retirement and you didn't make any loan payments. You didn't make any loan payments. So look at your loan interest. Your loan interest is compounding just like your account value. So remember my green line. My green line goes like this. My red line went like this. The red line was the loan balance. My loan balance is getting bigger at 5%, but my account value is getting bigger at 6%. It's the uninterrupted compounding interest and the 1% difference that is allowing you to double your retirement income. It's the uninterrupted compounding interest that's allowing you to double your retirement income. But the loans are also compounding interest. So when you die, you owe $5.5 million to the insurance company. Where's the insurance company going to get $5.5 million? Out of your $6.4 million. It's just like dying with a mortgage on your house. If you die with a mortgage on your house, the bank's going to take what you owe and give your family what's left, right? Okay, what's left? What's left is almost $1 million, $900,000. Remember, we started with $1 million. We're going to leave our family $900,000 plus a little bit of life insurance for a total of just shy of $1 million. Now that beats the heck out of the 4% rule because that's double the retirement income and it's all income tax free, and the death benefit is also income tax free. Now the death benefit does get added to your estate. So if your estate is in the millions and you could possibly be paying estate taxes, this could be added to your estate for estate tax purposes, but it's all income tax free. Most people aren't running into those estate tax issues anyway. But even if you did, this could definitely help. This could help pay your estate taxes. So anyway, that's how it works. That's how it works. It's that simple, okay? Now, maybe you can't pay. Maybe you can't pay $20,000 or $18,000 a year. Here's an example of $10,000 a year. If you're only putting in $10,000 a year, then the IRS only requires you to buy $165,486 of life insurance. I know it's a weird number, but that's the lowest amount of life insurance you can get away with without creating a mech. So in order to still make the IRS happy, you have to buy $165,000. But notice that that's less because we're contributing less, okay? Which means that our expenses are also less, which means that our interest is also less, and our account value is also less. And if we scroll down, our income is also less, but it's still double the amount that you would get in the 4% rule. Same concept. This can work for any budget. Whatever budget you have, the minimum for most companies is $50,000 to $100,000 of life insurance. So you have to at least buy $50,000 to $100,000 of life insurance. So this might not work if you're 60 years old and you want to, only want to put in $50 a month. So there is some limits, but you could do this for your kids, grandkids. You could do it for people that are in their 60s, 70s. It doesn't matter. This still works. Okay? Same concept. Let's look at another one. Let's look at a 50-year-old that's a little bit behind, or they want to start moving money over into one of these life insurance plans. Now, you can't move your 401k money into one of these unless you're past 59 and a half. So you can't move your money from an IRA or a 401k into the life insurance because they're taxed differently, okay? So this is a 50-year-old that's going to start moving maybe some money that they have in a brokerage account so that they don't have to pay taxes anymore. Or maybe they're just trying to make up for lost time. Maybe they're trying to catch up on retirement. Maybe they're a high income earner and they're putting in $60,000 a year, but they're done. After 10 years, they're done. So after they're done, what happens to the insurance? We can reduce the insurance. Now, this $60,000 a year requires $750,280 of life insurance so that it's not a mech. That is what we call maximum efficient. This means that the apartment is at 100% occupancy. You don't have to put in $60,000 a year. That's the maximum. The minimum would be the expenses. Okay? Now, yes, the expenses are high in the beginning, but if you had $1 million, in a brokerage account at 1%, you would be paying at least $10,000 in management fees plus taxes. And in this example, with $1 million, you're only paying about $1,000. That's like 0.1%. The fees are just front loaded and then they're low over time. In fact, let's go ahead and scroll down and let's look down here. Our expenses compared to our interest is much lower. Okay? Much lower. It works great. We're continuing to take all this money, borrowing the money, income tax free in retirement. So when we die, we have $6 million. We owe the insurance company $5.5 million. That comes out of our $6 million. We leave our family $670,000, which is our account value minus our loan balance plus our life insurance equals the death benefit. Now, how in the world can the insurance company afford to do this? How can you invest $600,000, spend $2.4 million in retirement and still end up with $670,000 when you die? Well, the insurance company is going to collect $365,000 of expenses and they're going to collect $3.1 million of loan interest when you die. That's like being a mortgage company. That's a lot of interest. That is profit to the insurance company. And the loan was secured by your money the entire time. I forgot to mention something very, very, very important. I should have mentioned this earlier. You are never, ever in debt. This would make Dave Ramsey happy even, because you are never in debt. You always have more money than what you owe. You cannot borrow more than what you have to borrow. Okay? So your cash value is used as collateral. But the insurance company is never worried about this loan balance, even though you're not making any loan payments. They're never worried about the loan balance because the loan balance is secured by your account balance. Right? You've got collateral, just like a mortgage has collateral, right? If you ever wanted to pay off the loan balance, we could take money from our account balance and pay off our loan balance. But if this is earning 6 and we're only having to pay 5% over here, why would we take this money and pay off this money? It makes no sense. But you could, okay? Do you want me to tell you how to pay off your mortgage? Sell your house, okay? If you sell your house, you can pay off your mortgage because your house is being used as collateral. You're actually not in debt. A mortgage is not debt because you could pay off your mortgage by selling your house and be out of debt if you wanted to, okay? It's the same thing here. We have collateral. Now, going back to what I was saying, the insurance company is going to collect a lot of expenses. They're going to collect a lot of interest. And guess what? Out of the $670,000, how much of that do they have to pay out of their pocket? Out of their pocket, they only have to pay $61,000. The life insurance, the available cash value, that $600,000, that's yours. That's not theirs. That's your money. That's your cash value. Okay? Now again, these are huge numbers. Maybe $30,000 a year as a 50-year-old is more your style. $30,000 a year, same concept. Your expenses are a little lower, your interest is a little less, your account value is a little less, your available cash value is a little less, but your life insurance is also a little less. It's all related. And if we scroll down, you can see that we're getting $40,000 a year in retirement. You would need $1 million for that same $40,000 a year in the 4% rule. This is $40,000 a year. Let's scroll down and look at these final years. Same concept. $40,000 a year. You never interrupted any of the compounding interest. Your loan balance is growing because you never made any payments. Now, I want to use this as another example to talk about what if you want to pay off your loan balance. Let's go back up here. Let's just say that in your 70s, you get an inheritance. If you get an inheritance and you have this large chunk of money, where could you put this large chunk of money and have it grow tax-free the rest of your life? Well, you can't put it into the life insurance because you have a maximum amount that you can put in every year. It would create a mech. You can't just drop $500,000 into the life insurance or it would create a mech. But you could drop $500,000 in here to pay off a loan. So we could take that $500,000 of an inheritance, we could put it into the life insurance by paying off the loan. And if we pay off the loan, now our available money is the same as our account value. So now we have more money to use in retirement, income tax free. That's how you could take an inheritance, put it in and have it all grow tax free. And again, once again, I want to reemphasize, you're never in debt. We're never in debt because our loan balance is always less than our account value. So you're never in debt in this particular example, right? All right, now, let's look at somebody who has already money saved. This is a 55-year-old that already has money saved, and you want to move the money over as fast as you can. So let's say that you have $375,000 in a brokerage account or in something that you want to move it into the life insurance. Maybe you have IRA money, 401k money, and you're over 59 and a half. If you're over 59 and a half, you could pay your taxes and move the money over without a penalty. You're going to have to pay your taxes anyway. You have to pay your taxes anyway. So we could move the money over and it would never be taxed again. So in this example, this is the fastest you can move the money over without creating a MEC. Now we have to buy a lot of life insurance, but that life insurance is going to go down. Okay? So we're able to quickly move money in and build up this account value, and then again, borrow the money in retirement. Same story over and over. Okay? All of this money is available for an investment if you want. Okay? You could borrow this money. You could pay back the loans if you want. You could take out a loan, pay back the loans if you wanted to. Okay? And all of your money would continue to compound interest. If you took out a loan, paid back the loan, that's like taking out a home equity loan, paying back the home equity loan. It doesn't affect the growth. The compounding interest is still compounding interest. Okay? Pretty cool, huh? All right. Now, obviously, again, we're talking about some big numbers here. Maybe you have $150,000 a year. All right? Maybe you want to move over $750,000 and then retire on $80,000 a year income tax free. Same concept, but now you have to buy a lot more life insurance, which is fine. Yes, your expenses are higher, but so is your interest and everything else. It's all tied together. Same concept. We could look at a number of different numbers, okay? Lots of different scenarios. Now, if you want to learn how to use this to pay for college, then secret number 3 goes into this in a lot of detail. But I just want to show you as an example of how we're able to put in $32,000 a year for 10 years, take out a bunch of loans to pay back college for some kids. In this example, we've got like 2 kids that we're going to pay back their college loans with this example. Yes, we're going to take out life insurance loans to pay back our college loans. Or you could use this to pay for college directly. But in this example, we're taking out loans clear up here in year 5. You could have a senior in high school and use this. And you could still use this for retirement as well. You can take out loans to pay for college and then take out more loans for retirement. You could take out loans to pay your taxes. You could take out loans to invest. You could take out loans. If you're able to borrow money at a guaranteed 5%, you could take out a loan at 5% and loan it to somebody at 10% for a hard money loan when they're building a house, as an example. You could actually take out a loan to make money. You don't have to just take out a loan to spend in retirement. You could take out a loan to invest and make money. Pretty cool, huh? That's where it really gets fun, okay? So that is just an example of all the different ways that you can use the life insurance in these loans, but it's double your retirement income, right? Double your retirement income. Now, let's step it up a notch and talk about how to triple your retirement income. All right, now, before we talk about tripling your retirement income, let's just talk about a few different ways that we can use this life insurance and talk about some pros and cons real quick. So you can use this to pay for college. I teach that in secret number 3. You can use this for weddings. My oldest daughter just got married. You can use it for something expensive like a wedding or any other major capital purchase. You could use it to buy a car with if you wanted to. Why? Because maybe the interest rate is lower and you don't have to make any loan payments, but you could make a loan payment just like paying a bank, but now you pay yourself back. Works pretty great. Taxes. My dad had a lot of money in real estate, but he used one of these life insurance plans to borrow against every year to pay his taxes. When he died, he had several loans outstanding, but he was able to pay back those loans upon death out of the death benefit. That loan balance came out of the death benefit, and my mom was able to receive the difference. Works great to use to borrow for taxes. All right. How about retirement and other investments? Obviously, we just looked at a lot of retirement examples, but you could also take a loan to put down on real estate, or maybe the stock market crashes and you can borrow money and invest in the stock market and catch the wave going up. Works great for that as well. Double the retirement income. We're going to talk about tripling your retirement income in a minute. But double the retirement income. Uninterrupted compounding interest is the secret. Competitive indexed returns. No stock market losses. Tax-free growth on the money and tax-free income and access to the money through the loans. If you withdraw the money, you could pay capital gains tax. But if you use the loans, it's income tax-free. Income tax-free death benefit. Okay, guaranteed loan approval. Okay, guaranteed, no application process. Fixed 5% loans if you choose the right product and the right insurance company. Some insurance companies are charging variable loans that could go up to like 15%. Be careful with those. That could blow this plan up in a hurry. Okay, flexible payments on those loans, or no payments at all, or flexible payments into the life insurance. You, again, don't have to put in that maximum amount. If there's a bad year, you could skip a year. All right, there's flexible payments. If you already have like a whole life policy or a universal life policy or like a variable universal life policy, and you like this indexed idea better, you can move that money over without any tax consequences. That's what we call a 1035 exchange. What are some of the negatives? Limited access in the early years. You remember it was like 12 years, 10 to 12 years before you have access to all of your money. So that's, something to consider. There are ways around that, but that is something to consider. You must qualify. It is life insurance. You have to get approved for the life insurance. If you have health issues, that could be an issue. Hopefully, maybe you have a spouse that could qualify, or again, you could even use this for kids and grandkids. Okay? It requires a different mindset. But if you're in the top half of the country, or if you want to be in the top 1% of the country, then you need to think like these wealthy people think. So I want to kind of give you some general recommendations. There's 4 categories of money. There's money for emergencies or for investment opportunities. In other words, money that you need access to. If you need access to the money, I strongly recommend the life insurance. Not the Kaizen, not the premium financing, just the regular life insurance as a maximum efficient contract with minimum insurance, because you can borrow against it for an emergency, or you can borrow against it for an investment opportunity, and you could pay back the loans or not pay back the loans. Totally up to you. Okay? Now, you also have limited access to the money in the beginning, so maybe for the first couple of years, you just put the money into the bank. Now, I can't tell you where you can get a decent rate of return and still have access to the money with no risk. You could put your money in the stock market, but you could lose it. You could put the money in the bank, but it's not going to grow. But if access to the money is important, then you might give up rate of return for access to the money. But if you can wait a few years, you can't beat the life insurance for access to the money. How about money that you're saving for retirement? I know that I'm going to sound biased, but I believe in my heart of hearts that you cannot beat the life insurance when it comes to saving money for retirement. Now, is your company giving you a match on your 401k? Well, great. Look at the Kaizen premium financing product. Talk about getting a match. That's the best match ever. If you really want to put in just enough to get a match, then put your money into the Roth 401k, and the company will match your money in the traditional 401k side. But I truly believe that taxes are probably going to go up in the future. So I would put your money into the Roth 401k and I would only put in what they're matching, not a penny more than what they're matching. And I would honestly consider how that premium financing compares to even what you're getting in a match, because you can also get a match from the bank. So I would strongly consider the life insurance as a way of saving money for retirement. I honestly don't think you can beat it. I don't think you can beat it because it's all income tax free, guaranteed to never lose. I mean, you know all the benefits that we've been talking about. Okay, now the third category of money would be the income that you need during retirement to cover your basic lifestyle, to cover your expenses, to cover your insurance costs, your utilities, your mortgage payment, whatever it is that you have. This is to cover your nut. I strongly believe that you will not find a better income in retirement, especially that is guaranteed, than you can from an income rider on that indexed annuity off of that protected income value. So if you already have money, if you have IRA money, 401k money, money that you want to carve out to cover your basic living expenses, you can't beat the income from that annuity. However, you could also get income from rental properties. But again, what if you don't have a renter? If you don't have a renter paying rent, then your income goes down. Those are some things to consider. The annuity is going to give you that guaranteed income during retirement that will also be guaranteed to go up as the market goes up to keep up with inflation. Very difficult to beat that from a retirement income standpoint. So for any 401k money, IRA money, or just carving out some money from your taxable brokerage account, anything that you want to give you a guaranteed lifetime income stream, I would consider looking at the numbers of how the protected income value will give you the maximum income stream. But again, retirement income is also optional, rental income off of real estate is also another option for this category of money. And then the fourth category of money is money that you want to pass on to the next generation. Now, in my opinion, this is where your stocks come in. Just like we talked about earlier with the wealthy that are hanging on to their stocks and not selling them because you're not taxed until you sell them. Now, if you're trading them on a yearly basis and you're creating a lot of taxes, not very efficient actually. But if you can pick some good stocks, leave that money alone and let it grow and compound, and all of that money passes to your kids because you don't need it to live on. If you don't need it to live on, but it's nice to have in case of an emergency or in case you live longer than you think or whatever the case may be. But money in a stock portfolio is a great way to leave money to the next generation because they get that step up in basis. They don't have to pay taxes on it. They could get that money tax-free upon death if you don't sell it while you're alive. If you do sell it while you're alive, then there's of course taxes on it. Real estate is also a great way to pass money to the next generation. You could pass money through real estate because your real estate, whether it's just a family cabin or a condo on the beach somewhere, or whether it's all your investment properties, they can all pass to the next generation income tax free because of that step up in basis. Real estate is an excellent way to leave money to the next generation. And of course, life insurance. Life insurance is literally a check that they receive. They don't have to worry about selling real estate. They don't have to worry about when to sell the stocks. You don't have some kids that want to sell and some kids want to hang on to it. I mean, obviously there's a lot of things to consider that go way beyond the numbers when it comes to leaving money to the next generation. The way that the kids get the money and the fighting that might go on, this can get ugly. So to keep the peace, sometimes life insurance where you have a trust that identifies how the money gets passed to the kids. You could maybe even have the money go to the grandkids. So the money passes to the trust. The trust identifies that the grandkids have to use the money for college or for a down payment on a house, whatever the case may be. But those are all some great ways to leave money to the next generation. I do believe in my heart of hearts that leaving IRA money to the next generation is not ideal. The government will get a huge chunk of it. You're going to be destroyed in the taxes are going to destroy that IRA money when it passes to the next generation. I strongly believe all IRA money, 401k money, all those qualified plans should be spent in retirement. That's what they were for anyway. In fact, the government has required minimum distributions. They force you to spend that money in retirement. Put that into an income driven, like a protected income value, a guaranteed income stream, an income rider on the annuity so that you have that guaranteed income. I would not leave your IRA monies to the next generation if possible. So those are some things to consider.